Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today is Saturday, it's February 25th, 2012, and like we do every weekend, I like to go through and run my value scan and see if I can't find anything out there that might be a possible value investment out. And so this weekend, we're looking at JP Morgan Chase & Company, ticker symbol is JPM. We got the tools here. All right, there's the ticker symbol right there. And you can see that I have the book value, current recorded book value is 46.23. It's right here, and this line indicates that. You can see that we have a closing price this week at 38.28 per share right now. So we're trading pretty well below book value there, and definitely something you want to look at whenever you're having a situation like that. But not every time that a company trades below book value does that necessarily mean you have a good quality buy opportunity. We mentioned last week, we showed you an opportunity out there that would catch a lot of different investors' attention, but didn't actually show itself as being truly undervalued. This is a 10-year chart showing you all the price activity for the past 10 years, and you can see where we stand now in relation to the low of 09, so forth and so on. So let's go look at some fundamentals and see what we can find out about this company. Okay, here we are looking at the JP Morgan Chase & Company's summary on their fundamentals, and on the stock page here on Yahoo Finance is what I'm getting this information from, but you can find this information almost anywhere. I say that almost every week. You can get this information on, Google's got a finance page, MSN Money, etc. You can also find this information for free on your discount brokers page under the key statistics there. Just a quick little glance here, you can see the dividend yield is $1 per share. That works out to be 260 or 2.6%. You can see earnings per share of 448. We know if we've done any fundamental analysis, education, looking at Benjamin Graham, Warren Buffett's teachers, tutorials there, you know that he would recommend a minimum of $1 per share, and we have here 4.5 times that, just about. PE ratio, which is obviously very nice at 8.5. And when we're looking at the PE ratio, we're looking for something that's 15 or lower. That's our reasoning behind that. We have a video coming out later this week that will be talking about PE ratios. For those of you who are not familiar with them and all the different ins and outs of PE ratios, we'll have a video on the website there you can look at in a moment. Let's dig in a little bit deeper now and see if we can't learn a little bit more about this company. We'll look at some key statistics here. All right. And you could take this analysis much deeper. You could start looking at the income statement, balance sheet, and cash flow. I'm just going to look at a couple of key statistics here that may tell me what I want to do with this company, whether I like it or not. Okay. Right off the bat, like I said, the trailing PE ratio we already know is an 8.5. We like that, but the forward PE ratio is even better at 7.13. So this is telling us that the earnings projected into the future are better than the current earnings. Now, of course, that's just a projection based on somebody's sit down and thought this is what I think is going to happen, but you never really know for sure. But if they give you a projection of worse than expected, that's more telling than anything. It's that the company is actually coming out and saying we don't like what we see in the future. Okay, in this case, they're not saying that. The market cap, 145 billion, is obviously a large cap. Enterprise value is 6 billion. We've already got videos on our free website discussing what this means and what this means. You can check all that out for yourself. Let's move on down and see what else we have here. Alright, some other key statistics that I like to look at whenever you're analyzing a company. Always check the profit margins. There's another video we have coming out discussing profit margins. Profit margin is really important for multiple reasons. Obviously, the most obvious, of course, would be a large profit margin gives you room for error before you get into losing money. So that's important. I like anything that's 15 or better would be preferred. This one's 21. That's fine with me. It's actually quite well. Return on equity, another important key metric here, 10.5%, and I like this a lot as well. This is another one that items that we will be having a particular video on, just going over the return on equity and what it all tells you. I'm not going to go into it in this video, but you can watch it on our free website. Again, when you're looking at this, I like to see a 15%. 10% is okay, but it's not as good as I'd like. But again, banks have been hit pretty hard as of late. A lot of new rules come out and change the way they do business, and that's hit them pretty good. So that's some of the reason why you're seeing the stock down as well. Quarterly revenue growth is down year over year, 16%. Let me move on down so you can see a little bit more. All right. And quarterly earnings growth year over year is also down 22.8%. Again, these are typically short-term situations here that we're seeing that are telling us, can tell us why the stock is out of favor at the moment. But that's what we're looking for, is an opportunity where the stock's out of favor, but the quality of the business is still really strong. Return on equity is strong. Profit margin strong. Operating margin strong. We like these things. All right, we've moved down and we'll look at a few more items here on the balance sheet. A couple of key statistics. You can see that cash, or total cash, is $824 billion versus total debt of $684 billion. I like this, and here's why. I don't like to buy companies that have debt. I don't like that at all. I don't mind it so much if they've got enough cash on hand that they could actually pay off the debt. Then I feel like they can manage their debt, and I'm not too concerned with that. So it doesn't bother me at all. Here we get book value per share of 46. That's liquidation value. Of course, book value can be manipulated. This is true with any company. You'll have to actually dig into the balance sheet to find out if it's manipulated, if it's inflated or whatnot, and that's something you should definitely always look for. But again, right now we're just looking at where we are on recorded key statistics, and this is the book value share, 46.23 per share. Naturally, another item we want to know is what kind of institutional holdings do we have, insider holdings, who's holding the stock. Percent of the company that's held by insiders is 74%. That's cool. I would like that a lot. Percent held by insiders, very low, but again, a massive company. That's kind of common there. Let's clear that up and move on down a little bit more. You can see that we look now at the dividend yield. You can see that you have that 2.6% dividend yield there. Trailing annual dividend yield 2.6%, forward annual dividend yield 2.6%. You can see also the payout ratio is very important, and this is showing you 18%. 18% of their earnings goes to pay out the dividend. If this number were 100, 200, or in the case of Bank of America right now at 400%, that tells you they're paying 4 times their earnings just to service that dividend. And that's in the case of Bank of America. In this case, we're only paying 18%. So we like this. This is a much better scenario of them being able to continue paying that dividend, or maybe even increase it. So that's something else to keep in mind. Okay, now you know what I know regarding this company. If you've not been to our free website at perfectstockalert.com, it's right there. It's 100% free. All we ask in return, please refer a friend. Also, you may share our videos online. God bless, take care, and I'll see you all again next week. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.